Yo, what's good? In this video, I'm going to be talking about all-in-one funds. But before we get started, let me know in the comments, if you could only buy one stock or one ETF for the rest of your life, what would it be? And while you're down there, please hit the like button as it really helps the channel grow. If you remember my video a few weeks back on Wealthsimple Invest versus Questrade, I said you were able to build Wealthsimple's portfolio by yourself for a much cheaper fee. In order to do that, you would have to buy and manage multiple ETFs, and on top of that, rebalance your portfolio every so often. And for a lot of investors, that's complicated and seems like a lot of work. But what if I said there was an in-between? If there's a way to get Wealthsimple's Invest ease of use and diversification on a self-directed brokerage account like Questrade or Wealthsimple Trade. This is where I want to introduce all-in-one funds. All-in-one funds, or asset allocation ETFs, are basically ETFs that hold other ETFs. So when you think of the word ETF, you're probably thinking of a basket of stocks. Well, in the case of this asset allocation fund, it's a basket that holds other baskets. This allows these asset allocation funds, or these all-in-one funds, to have an insane amount of diversification while still having a pretty low fee. So there are two really popular all-in-one providers in Canada, BlackRock and Vanguard. Both offer different portfolios depending on your risk level, and it's very similar to how Wealthsimple Invest has their risk levels laid out. Both Vanguard and BlackRock offer equity, growth, balanced, conservative, and income portfolios, and then they just kind of slap the letter X or V on it, X for BlackRock and V for Vanguard. So the level of risk for these portfolios is dependent on the ratio of stocks to bonds that each of the portfolios have. So if we take, for example, the income portfolios from each of them, X, INC, and VCIP, we can see that these are the lowest risk because they have the lowest allocation of stocks. So here they have 20% allocated to stocks and 80% allocated to bonds. And then if we take a look at the highest risk portfolios, XEQT and VEQT, we can see that it has 100% allocated to stocks and 0% allocated to bonds. These portfolios allow investors to get access to a low cost and diversified portfolio that matches their current risk level. All right, so how diversified are one of these all-in-one funds? I've pulled up the XGRO fact sheet just so that we can go through it together. So as we can see here, this is the fact sheet. It shows you a bunch of cool information that's really helpful. So for example, as the price up here, it also has a total percent return over certain periods of time, which is really great to know. If we scroll down to the key facts, we can see that this ETF XGRO is made up of 8 underlying holdings. So like I said before, an all-in-one fund is an ETF that holds other ETFs. So if we add up all those stocks and all those bonds in those ETFs, we get a total of 18,749 total investments. Which basically means if you were to buy one share of XGRO, you'd be getting a tiny piece of 18,000 other investments. Now, this is a very oversimplified explanation of how it works, but I think it gets the diversification point across pretty well. So now if we scroll down to the ETFs that XGRO actually holds, we can see what XGRO is made of. ITOT is an ETF that tracks the total US stock market, and it makes up 37% of XGRO's profile. So if we go to the ITOT fact sheet, we can see that it has a total of 3,639 stocks that it invests into. Let's take a look at another example. XIC is an ETF that tracks the TSX, and it makes up 20.3% of XGRO's profile. So if we go to that fact sheet for XIC, we can see that it holds 234 stocks. And let's take one more look at a bond one just to round it out. So here we have XBB, which is an ETF that tracks universe bonds in Canada, and it makes up 11.5% of XGRO's profile. So if we go to the XBB fact sheet, we can see that it has an MER fee of 0.1%, and it has a total of 1,375 bonds. So if you add up all these ETFs underlying holdings, you're gonna get to that 18,000 number. And additionally, if you add up all those MERs, you're gonna get close to 0.2%, which is charged for this ETF. But of course, BlackRock's gonna add a little bit more just because they have to manually rebalance, but that MER fee is gonna be very small. So I just went through 3 of the ETFs that make up XGRO. As you can see, you can go to this website and look at all of them if you want, but hopefully this illustrates how these all-in-one funds are built. What's great about an all-in-one fund like XGRO is that it automatically rebalances itself for you. The trade-off is the MER fee is 0.2%, which is higher than the MER fee of all the underlying assets added up together. But the convenience of having to only buy one ETF rather than 8 and not having to rebalance is a huge plus. What's also great about these all-in-one funds is that they're ETFs, which means you can buy them in your TFSA or your RRSP and let your investment grow tax-free. On top of that, Questrade doesn't charge you commission fees when you buy ETFs and only charge you commission fee when you sell. And on Wealthsimple Trade, these ETFs are always free whether you're buying or selling. Now, there are a lot of these all-in-one funds, so which one is the right one for you? First thing you have to do is determine your risk tolerance. If you've never done a risk assessment before, I'll leave one in the description. Go do it right now. It only takes 5 minutes. Trust me, I'll wait. Done? Okay, cool. After you figure out your risk tolerance, you have to select your corresponding risk level. Say for example, you got a risk score of 80% stocks, 20% bonds. That means you're selecting between XGRO or VGRO. If you're deciding between XGRO and VGRO, honestly, you can flip a coin and win regardless. I personally think both of these funds are really great and you can't go wrong choosing either of them. The main difference is that BlackRock funds are cheaper by 0.05%. And this really isn't a big deal. For some context, on a $10,000 portfolio, that difference is only $5 a year. There's also small differences on how these portfolios are built and what kind of bonds they use and when they rebalance. But honestly, all of these changes are so small that it does not really matter. You're gonna stress yourself out nitpicking over these tiny little things. I do wanna make one quick note. XGRO and XBAL are PAC eligible, which means that your contributions can be 100% automated. I'll leave a link to the description on more about PAC eligibility. But again, I just want to stress, aside from picking the correct risk tolerance, I don't think you can go wrong choosing either the Vanguard or the BlackRock option. Okay, so how do these all-in-one funds compare to the other options that are out there? In my opinion, there's 3 ways to invest into a globally diversified portfolio, going from cheapest but most work to most expensive but least work. On the left side, we have a DIY portfolio. This is by far the cheapest option, but it requires you to do the most amount of work. By creating your own portfolio, you can make a very diverse portfolio for a much cheaper fee than if you had gone with Wealthsimple Invest or an all-in-one fund from BlackRock or Vanguard. For example, we can take a look at PWL Capital's model portfolio. It has 5 ETFs that you have to manage and it comes in at 0.11% for the MER fee. This is 2 times cheaper than investing into a similar portfolio from Vanguard or BlackRock. Now the downside to this is that you have to buy 5 ETFs instead of 1 and you have to periodically rebalance your portfolio. And for a lot of people, that amount of work is not worth the reduced fee. If you want to turn the convenience dial up a bit, you have the middle ground, the all-in-one fund. These funds offer investors a very diversified portfolio at pretty low fees ranging from 0.2 to 0.25%. And every single time you want to contribute to your portfolio, you only have to buy 1 ETF rather than buying 5. And you don't have to worry at all about rebalancing your portfolio. The hardest part about these asset allocation ETFs is remembering to log in and buy shares. But say you're really lazy and you want to crank that convenience dial all the way to the max. This is where you have robo-advisors like Wealthsimple Invest or Quest Wealth. And these platforms do literally all the work for you. They take the money out of your account, they rebalance your portfolio, and all you have to do is do a questionnaire and determine when and how much to invest. And then from there, it's like letting Jesus take the wheel. In my opinion, all these options are great and they have their own strengths and weaknesses. All-in-one funds are a great middle ground between having a robo-advisor and doing it yourself. These funds allow investing to be really cheap and easy for the average investor who wants to save a bit more on the fees but doesn't really want to create their own portfolio and be an investing wizard. The biggest downside to these asset allocation ETFs in my opinion is that they're not flexible. For example, VGRO has a 24% allocation to Canadian stocks when Canada only makes up 3% of the global market cap. Now, there's an argument for this level of home bias, but honestly, that topic's pretty confusing and I don't really want to talk about it, so I'll link a video to Ben Felix, who's much smarter than me, and you can watch his video if you want to learn more about that. Regardless if you think this asset allocation is too much or too little, you can't change it. By investing into an all-in-one fund like VGRO, you're basically trusting Vanguard to make the decision for you, and you're not able to change any of it. Additionally, in a DIY portfolio, there's ways to break up your portfolio to make it more tax efficient. For example, investing all of your US dividend paying stocks into your RRSP before your TFSA in order to save on that US withholding tax. With an asset allocation ETF, you're not able to do any of that because it's super inflexible. But to be fair, a lot of investors don't really care for that level of tax efficiency. And honestly, I don't either. I'm not a tax wizard, so I would not honestly just touch it. I just leave it. But it's something I wanted to put out there. It's not super important, but something you should take into consideration. Overall, these funds are a great way to invest into a globally diversified portfolio. They have really low fees and are much cheaper than investing into something like Wealthsimple Invest. You do have to put in a little bit of work to learn how to use Questrade or Wealthsimple Trade and remember to log in every week or month to buy shares, but other than that, it's completely hands off. I personally have money invested in an asset allocation ETF because for me, I think it's the perfect balance of being easy and being cheap. Maybe in the future, when my portfolio grows large enough, I'll care more about the MER fees or making my portfolio more tax efficient. But right now, I'm really happy with the fee because honestly, I'm really lazy. But if you're currently deciding on which of the 3 options to choose, I honestly think the best option for you will be the one that you actually use. But that's all I wanted to say for this video. Thanks for watching if you made it this far. If you liked it, please consider liking and subscribing. I plan to make a new video every 2 weeks, so hit the bell notification so you don't miss out. If you have any questions or comments, feel free to leave them in the comments below or hit me up on Instagram. But other than that, thanks for watching. I'll see you guys next time. Later.